Hi and welcome. This is the final lecture for this week, and we're doing chapter 24 in your text. And this leads into the assignment, which is a significant assignment for common sizing, which you'll see when we complete this section. So we're going to be talking about ratio analysis. So ratios are very useful um, because they help us understand internally what a company is doing and also help us compare companies even though their size and numbers may be quite different. So if we convert dollars to ratios, we can compare different types, not so much different types of companies, but different sizes of companies. So very useful for analysis. They help us figure out trends. They help us figure out what we're doing relative to our competition. They point out possibilities for improvement, and for outsiders, whether a company's management is doing a good job or whether maybe we should be looking elsewhere to invest our dollars. So yeah, ratios only matter when you can compare. So we may be looking to compare this year's results to last year's results, or the last several years' results, and look for trends. Are things improving, or certain areas improving or declining, and why? We may be comparing our numbers to other companies that are similar to us, competitors, or we might be able to find industry-wide numbers and compare our uh, data to industry-wide numbers. Um, if we're in the car industry and we're Ford, we might compare our numbers to General Motors, or we might choose to compare our numbers to industry-wide, all of the US manufacturers, which is surprisingly lots, because lots of companies make cars in the US, even if they're not US companies. So industry-wide competition, specific competition, and ourselves, what's happening in the past for ourselves. So historically, we look at the trends. So if we've seen, let's say, our current ratio, which tells us about liquidity, and that's getting worse. We're becoming less liquid over time. Why is that happening? Is it acceptable, or is it a danger signal? The other, and then you can do that for any set of ratios, gross profit margins or net profit margins or sales or anything. The next area that you might use comparisons is exception analysis. So when you're looking at a firm, what number is sticking out as the cause of other numbers? So maybe gross profit is the only number that's really changing a lot percentage-wise. So maybe that's the thing we want to look at. So you're able to focus your attention on things that are different as opposed to things that are what you would expect. So comparing results to businesses in similar situations, you may be able to, as an internal use, you may be able to improve your focus and figure out what I could do better. So if somebody's doing a better job in a certain area, let's say their fulfillment or delivery costs are lower than mine, what are they doing to do that? How are they getting their costs, their logistics costs or their shipping costs lower? What is it that they're doing to do that? That's something that you might want to look at. Um, you might learn things that you have advantages on that you can exploit, things that you're better than your competitors at. Maybe you can exploit those advantages. When you're doing industry-wide comparison, there's several places where you might get numbers. The Journal of Commerce publishes a lot of data that's industry-wide, especially about the maritime industry. Dun & Bradstreet generally publishes a lot of information, though they usually charge for theirs. So you probably aren't going to have access to that if you're trying to do analysis and not pay for that data. And then lots of industry associations collect data, and it's generally publicly available. So you may be able to find industry-wide comparisons for some industries in a free form, a free source or open source data. You do have access to the Maine Maritime Library's databases, and you can use them. And then if you can find industry associations that fit your needs, you may be able to get information there. One very powerful tool for analysis is common sizing. And that means basically taking a financial statement and turning it from dollars into percentages. So then we can compare the percentages of company A to company B without getting involved in whether company A might be significantly bigger or have different dollar figures than company B. It's a very powerful tool. It's very easy to do. Be careful when you use common sizing not to go cross-industry, because cross-industry analysis usually doesn't work very well. Trying to compare Microsoft to Kirby, really difficult. Microsoft doesn't own many assets. They have a lot of intellectual property. They sell things that don't cost anything to build. They cost tremendous amounts of dollars to develop, but they don't cost anything to scale, to build more and more copies of. Whereas shipping goods in barges requires lots of capital equipment, and it isn't as scalable. It's scalable, but only with significant investment. So don't try to compare across industries, but within an industry, that's a very useful tool. So when you're common sizing a balance sheet, you basically divide each number on the balance sheet by total assets. So everything is the denominator is always total assets, and the numerator is whatever asset you're common sizing. So cash divided by total assets, accounts receivable divided by total assets, and so forth. And on the liability side, it's the same thing. It's going to be accounts payable divided by total assets, notes payable divided by total assets, and so forth. So always use assets as the denominator. And then when you common size the income statement, the denominator is always total revenue. So total revenue, total sales, or total revenue is your denominator. And you may compare cost of goods sold to total revenue, or you might compare marketing cost to total revenue, or whatever. So you might find that one company that you're analyzing spends 3% of sales on marketing, and another company spends 6% of sales on marketing. Well, that's a significant difference. And what does that do to the rest of that company's financial statements? And does that extra marketing pay off? Are we getting benefit from that extra marketing? So that's kind of an example. Basically, when you're common sizing, you start out with the ratios and you use that information to guide your analysis. So it may be exception or trend analysis. If it's exception analysis, when you see something weird or change, when a ratio calls your attention to an account because of change, because of exception, because of its sheer size or its trend, then you dig in and figure out what's going on. Common sizing won't tell you what's going on, but it will direct your attention to areas that you may want to look at. So I have a few sample common sizing statements here. These come from your textbook. So here you have Pacioli Wholesale, and you can see that each asset has been converted to a percentage. Total assets, which is the denominator, is 100%. So it's 1 over 1, or 100%. 2.7% of cash. 2.7% of assets were cash in 2012, 2.5% in 2011, and so forth. So you've got 12 and 11 all the way across. Looking down here, do I see anything that is significant? Well, I see a relatively large drop in accounts receivable and a relatively large increase in inventory. So those are two things I might want to look at. What's going on with inventory? Why are we carrying more inventory as a percentage of assets than we were before? And why are our receivables down? Are we better at collecting them, or are we selling less? Who knows? I don't know. I have to look into that. Fixed assets. We've clearly added a lot of fixed assets. So fixed assets are now 50% of our total. And because of that, we have more depreciation as well. So net, we're up 4% in fixed assets. Land, that's a mistake. It's not 81%. There's an error there. And then I just took it from the textbook, not my error, somebody else's error. Total fixed assets are a little bit higher, so that might be something to look at. And goodwill has dropped a little bit. So we've written down some goodwill, maybe, I don't know. So those are things to look at from a common sized balance sheet. Here's a common sized liability. Oh, that's the common sized assets. Here's liabilities and equity. Once again, not much change here, a little bit, mostly in taxes payable. Our mortgage payable is down a little bit. Bonds payable as a percentage is down a little bit. Deferred taxes up a little bit. Not much change here. And then common stock and so forth. We made a lot of money, so we have an 11% retained earnings as opposed to 7%. So all we're doing is getting rid of the dollars and taking them to percentages, which lets our brain see what's going on. And think about this, if I've got numbers of years, it's much easier to see a trend if I'm looking at percentages than dollars. And then if I want to compare Pacioli Wholesale to some other wholesale company, it's quite easy for me to compare them, even though they might be different sizes. So that's balance sheet. And what I'd recommend to you, you're going to have a project to do this, is once you've done this, hide the dollars so you only look at the percentages, because the dollars get confusing to the brain, and the percentages are quite easy to understand. So once you've done your calculation, if you're doing it in Excel, you can always hide a column. It still computes, but you don't have to look at it, and it makes it easier to see and understand. And then this is a common sized income statement. So here my denominator is sales, so that's going to be 100%. And then what are my cost of goods sold? So my cost of goods sold were down significantly. So my gross profit's up a lot. What's going on here? This is really good, but why can I go from 42 to almost 46% in 1 year? That's a huge increase. My operating expenses held pretty steady, so 30% of sales, but my gross profit was up, so my operating income goes from 11 to 15%, and interest stays about the same, so income before taxes goes from 7 to 10, and net income goes from 11,000 to 19,000, 4.5% to 6.5%. That's a 50% increase in net income, and it's all because of my gross profit change. So when I'm going to do my analysis, everything else we're doing well on. We're doing, things are pretty consistent, but wow, gross profit's up a lot. What's going on? That's good, but I ought to know why. And if I'm looking at somebody else in the industry, if their gross profit isn't up also, maybe I'm doing something really well. If their gross profit is up too, then something's happening in this industry to increase profitability. The other thing to look at when you're doing common sizing is to do ratio analysis. So look at the ratios in chapter 24, very, very useful ratios, things like current ratios and debt to equity ratios, and all sorts of different ratios. They're all detailed in chapter 24. I want to see those ratios when I do common sizing because they also help me analyze financial statements. They're also very commonly used in business settings, so knowing ratios and the lingo of ratios is very important. You end up in a meeting and people start talking about return on equity or return on investment or debt to equity ratios or leverage or all those things. You need to know what they're talking about. And so understanding ratios is quite important, and knowing the common ones is important. So that's kind of a quick overview of common size.